1 millisecond, that's roughly 1/300th of the time it takes you to blink. And there are firms on Wall Street spending hundreds of millions of dollars fighting over it. Today we're going to talk about latency, what it actually is, why it matters, and how much of it you should actually care about, depending on how you trade. Let's define it plainly. Latency is the time it takes data to travel from point A to point B and back. In trading, that means the round trip from the moment you click buy on your app to the moment your broker's server receives that order and sends a confirmation back to your screen. That's it. It's a travel time, nothing more complicated than that. The reason it becomes such a big deal in finance is that trading is fundamentally a competition. Every order is racing against other orders to get to the matching engine first. And in that environment, travel time isn't just a technical detail, it's the difference between getting the price you wanted and not. Now, latency isn't one single thing. It actually breaks down into 3 distinct types, and most people only ever blame one of them. The first is network latency. This is the pure physical travel time, how long it takes your data to move through cables, routers, and switches between your device and the server. This is the one people think of first when they say, "My connection is slow." The second is processing latency. This is the time the server itself takes to actually do something with your request, validate your account, check your balance, route the order to the exchange. Even on a perfect network, a slow or overloaded server adds meaningful delay here. The third is application latency. This is the time your own app takes to process the server's response and render it on your screen. A slow or poorly optimized trading platform can add visible lag even when your internet and your broker's servers are both performing fine. Most people restart their app or blame their Wi-Fi when the real culprit is sitting in one of those other 2 buckets. Knowing all 3 tells you where to actually look. Here's where it gets interesting, because latency matters completely differently depending on who you are. If you're a long-term investor, buying and holding for months or years, 200 milliseconds of latency is invisible to you. Completely irrelevant. Your entry price on a position you're holding for a year isn't meaningfully affected by a fraction of a second. If you're a day trader, scalping small price movements, trying to capture a few cents of movement on a stock dozens of times a day, that same 200 milliseconds starts to eat into your edge. The market can move in ways that affect your fill quality in that window, especially during fast-moving moments. And if you're an algorithmic trading firm whose entire strategy is being faster than competing algorithms, you're not measuring latency in milliseconds, you're measuring in microseconds, millionths of a second. At that level, 200 milliseconds isn't a slight disadvantage, it's an eternity. The point isn't that lower latency is always better. The point is that your latency requirements depend entirely on your trading style, and most retail traders are operating at a time scale where the latency differences between brokers are genuinely irrelevant to their results. Now here's the part that surprises most people when they first hear it. There is a hard physical ceiling on how fast data can ever travel, and it's the speed of light. Data moving through fiber optic cable travels at roughly 2/3 the speed of light through glass, which sounds fast, but across real distances, it adds up to real measurable time. The distance between Chicago and New York is about 1,200 kilometers. Light traveling through fiber across that distance takes roughly 6 milliseconds one way. That's the floor. The minimum possible latency for that route, no matter how good your equipment is, because physics itself sets the limit. This is why physical proximity to an exchange genuinely matters for firms that need it. It's not about prestige or preference. It's about the fact that you literally cannot send data faster than light, and shorter distances mean fewer milliseconds, full stop. This is the exact reason colocation exists, which we covered in the Day 1 teaser and will break down fully in Day 10. It's also why some firms built microwave relay towers between Chicago and New York, because a signal through air travels faster than a signal through glass, and a straighter line is shorter than a cable that bends around geography. We'll cover that in Day 11. So what can you actually do about latency as an everyday trader? 3 practical things worth knowing. First, test your own latency, not just your speed. Most people run internet speed tests and look at download and upload numbers, but what you actually want to check is your ping, the round-trip time measured in milliseconds. Most speed test tools show it. A ping under 20 milliseconds to a nearby server is excellent. Over 100 milliseconds, and you'll likely feel it in a live trading platform. Second, wired beats wireless every time. A physical Ethernet connection to your router is more stable and lower latency than Wi-Fi. If you're actively trading and your Ethernet port is sitting unused, that's an easy win. Third, broker server location matters more than you'd expect. If your broker's servers are physically located close to the exchange you primarily trade on, your orders spend less time in transit. Some brokers disclose where their infrastructure is hosted. It's worth knowing, especially if you're an active trader. None of these will turn you into a high-frequency trading firm, but they're the practical, free or cheap optimizations that sit at the retail end of the same spectrum that billion-dollar firms obsess over at the institutional end. Quick recap. Latency is travel time, the round trip from your click to the server and back. It has 3 components: network, processing, and application. It matters more the faster your trading style and less the longer your time horizon. And there's a hard floor set by the speed of light that no amount of engineering can break through, only shorten the distance. Next time, we're going to clear up one of the most common misconceptions in this space: why upgrading to faster internet doesn't always make your trades faster. Bandwidth versus latency, explained with a garden hose. Subscribe so you don't miss it.